We often hear that timeless advice, right? Buy low, sell high.
Hmm.
But what if that low feels, well, absolutely terrifying, like real widespread panic? And what if the high feels like this amazing party everyone's piling into and you just feel you have to join?
Today, we're doing a deep dive into something called Contrarian Investing. We're drawing our insights from a really foundational text, Contrarian Investing. It's by Anthony M. Gallea and William Patalon III. Came out back in 1998 from the New York Institute of Finance, and it really digs into this fascinating kind of counterintuitive world of going against the grain in the market.
Exactly. And our mission today is to unpack what it truly means to be a contrarian investor. Why can this approach be so powerful? How does it cut through all that market noise? And crucially, what's the essential psychology involved? What are the signals you look for when you're purposefully swimming against the current? By the end of this, you'll have a much clearer sense of how to spot those opportunities that, frankly, most other people just miss. Okay, let's dive right in then. The fundamental question. How do Gallea and Patalon actually define contrarian investing? It sounds simple, but I'm guessing it's a bit more nuanced than just, being different for the sake of it.
Yeah, it's definitely more than just being oppositional. The book lays it out pretty clearly. It's investing against the prevailing public opinion. The core idea, and it's quite compelling, is that the majority of investors, they're often wrong, especially in market extremes. So when everyone's incredibly optimistic, super bullish, prices are likely way too high. And when everyone's panicking, totally bearish. Prices are probably at rock bottom. They actually call this the alligator
The
principle.
alligator principle, that's vivid. What does that capture? Does it imply struggle first, then success?
Precisely. The analogy in the book compares it to an alligator. Apparently, they thrash around like crazy when first caught, that's the struggle. But then, once they settle back into their element, they regain their strength. It's a great illustration of that initial pain, that discomfort of going against the crowd. That's the thrashing, which then potentially gives way to those market-beating returns the gain once the market inevitably corrects itself. It's really about enduring that tough initial phase.
So essentially it boils down to buying when the news looks awful and selling when the market feels like it can only go up. The authors have that famous quote, right? Sell euphoria, buy panic.
That really nails it. And if you connect this to the bigger picture, it just highlights how irrational markets can be sometimes. You've got Gallea with his serious portfolio management background and Patalon, a sharp business reporter. They combine their perspectives to show how emotional decisions, fear, greed, that herd instinct, often just completely override the cold, hard fundamentals when it comes to moving markets.
Okay, this is where it gets really interesting for me. If this strategy, buy low, sell high, is seemingly so simple, maybe even powerful, why isn't everyone a contrarian then? The book spends a lot of time on investor psychology. What's the main hurdle it points out?
Well, that's the million-dollar question, isn't it? The book argues quite strongly that the psychology of fear, greed, and especially that herd mentality is absolutely paramount. Going against the crowd requires just immense emotional discipline. Think about the groupthink effect. It's powerful. People naturally want to conform. It feels safer. So taking an independent stance feels incredibly uncomfortable, particularly when the majority opinion seems overwhelming, almost deafening.
Right, it's like resisting that primal urge to jump into the party when everyone else is celebrating, or fighting off panic when everyone around you is losing their heads. The book suggests this societal pressure, the practical effect as they might call it, actually makes people afraid to do what might be the most rational financial move.
That's precisely it. And it underlines why a true contrarian needs to cultivate this detached way of thinking. They almost have to be comfortable being a bit of a loner, at least in their market views. They need to constantly question assumptions, really understand that these widely held beliefs can cloud judgment. It's what causes people to hold on to losing stocks way too long or just completely miss the boat on great entry or exit points.
It's clear the mindset is absolutely critical. But, you can't just operate on a gut feeling of being contrary. So how does the book actually help you find these opportunities to avoid just being contrarian for the sake of it? What are some of the concrete signals Gallea and Patalon suggest looking for?
They give some very practical indicators, actually. One of the primary buy signals they highlight is something called the down by half rule. Basically, a stock that's plummeted a full 50% from its 52-week high. That's often flagged as an automatic buy signal for a contrarian. The thinking is that investors tend to massively overreact to bad news, pushing a potentially solid company way below its real value. And beyond that simple rule, they list several quantitative indicators that sort of scream undervalued.
Uh,
Things like a price to earnings ratio, PE, less than 12, That suggests the market isn't really valuing its earnings highly. Price to free cash flow, PCF, less than 10, meaning it's cheap relative to the actual cash it's generating. Price to sales, PS, under 1.0. The whole company's market value is less than its annual revenue. And price to book value, PBV, less than 1.0, implying it's trading for less than its tangible assets are worth. Oh, and a really big one, significant insider buying. Especially if it's over, say, $120,000. I mean, who knows? A company's real prospects better than the people running it.
Yeah, that insider signal feels particularly strong. That down by half rule is so simple, yet kind of powerful in its logic. But the book also uses history, right? It looks back at these infamous market manias, tulip mania, the crash of '29. What lessons do those historical blowups offer for a contrarian investor today?
Ah, yes. Those historical episodes are fascinating, and they really drive home the dangers of that collective euphoria and panic. Take tulip mania back in the 17th century Netherlands. Prices for tulip bulbs just went stratospheric, completely detached from reality, before crashing spectacularly. Or think about the intense speculation leading up to the 1929 crash. It was heavily fueled by margin debt, people borrowing money to buy stocks, which just magnifies everything, gains and losses. Contrarians learn to avoid what the book terms mania misery by recognizing these patterns. They understand that these extreme market moves are almost always driven by raw emotion, by excess, not by genuine underlying value.
Okay, so we have the psychology, we have these indicators, these historical warnings. Does the research actually back this up? Does the data show that these bad news stocks, the ones everyone's dumping, genuinely tend to outperform later?
It does, actually. The data provides strong support. The book cites research by a John S. Howe. He specifically looked at these bad news stocks, typically ones that had seen a big price drop, often around that 50% mark we talked about. And what he found was pretty compelling. These stocks frequently generated significantly large positive returns in the periods after the drop. It really underscores that idea. Investors, driven by fear, often dramatically overreact, and in doing so, they inadvertently create these prime opportunities for contrarians waiting on the sidelines.
That's powerful validation. The book gives some great examples to illustrate this, doesn't it? Can you walk us through a couple?
Absolutely. Let's see. Consider Philip Morris back in 1996. Despite all the controversy swirling around tobacco at the time, the stock took a 10% hit. That drop flagged it as a contrarian buy opportunity. Or Citicorp in 1997. There were big concerns about bad loans causing its share price to slide. But for a contrarian, that very weakness was the signal. Xerox in 1991 is another good one. They had a stock split, cut their dividend, the price fell. But again, opportunity presented itself. Even a giant like IBM in the late 80s and early 90s, remember all that management turmoil. The stock dropped significantly, yet it ultimately proved to be a very rewarding contrarian play for investors who were patient, who could see past the immediate crisis. It really shows that a company facing what looks like a disaster can actually be fertile ground for value.
Right. But given that you're intentionally wading into situations others are fleeing from, that sounds risky. How does the book advise managing that inherent risk when you're deliberately going against the crowd like this?
That's a crucial point. Risk management is absolutely key. The book strongly recommends diversification. They suggest building a portfolio of, say, 20 to 35 different stocks, and critically, ensuring that no single stock makes up more than maybe 5% of your total portfolio value. That spread is essential. It helps mitigate the risk if you happen to be wrong on any one specific contrarian bet. Because let's be honest, even the sharpest contrarian isn't going to get it right every single time.
This has been a really, really insightful deep dive into contrarian investing. Feels like we've covered a lot of ground. We've seen it's less about just being contrary for its own sake and much more about disciplined, independent thinking. Plus a deep understanding of market psychology and the ability to spot those specific, often counterintuitive signals like that down by half rule.
Absolutely. I think the key takeaway, the ultimate lesson here, is that real contrarian success doesn't come from blind opposition. Not at all. It comes from having the courage to think for yourself and, maybe more importantly, to act on that thinking precisely when others are at their most emotional, whether that's peak fear or peak greed. It's about recognizing that those market extremes, both the wild euphoria and the deep panic, are almost always temporary states.
So you've now got a powerful framework, hopefully, for potentially finding real value when the rest of the market is maybe panicking or getting carried away with irrational exuberance. And that leaves us with a final, maybe provocative thought for you to mull over. If the entire market is zigging, should you always zag? Or are there actually moments when the collective wisdom of the crowd might be right? And the really tricky part, how do you tell the difference? Keep observing, keep questioning, and definitely keep learning.